Speaking of such, state money, a well-documented source for private equity. For some firms, they are facing pressure on fees. According to CEM benchmarking, less than 50% of private equity costs incurred by U.S. pension funds are currently being disclosed. StepStone partner Michael Elio is here. He helps to manage $12 billion of assets. Michael, before we talk about fees, you just heard my colleague there, Jeff Flock. What do you make of the state of Illinois? Because some of these states' pension plans are your clients.
Yes. So I think Illinois is in a unique situation because of the legal structure that they have in their constitution. So it's a little bit harder for them to change how they're fixing their pension problem. A lot of other states have found other ways to solve the issue. New York, for instance, they have a tiered pension system. So all new employees coming on have a different level of expectation in what their benefits will be. And those are benefits that are actually being funded by the state.
So what are you seeing then? I mean, are pension plans, that is to say, the people managing money for state workers, are they coming to you? Are they still good LPs or limited partners?
They are. They are. Because when you think of a pension fund, there's really two ways to solve the problem. One is effectively to give up and get rid of defined benefit plans.
And basically just reach out to people and say, we know you said you're going to get $80,000 a year as a pension. You're not. Sorry, it's 60.
Exactly. You're going to go into a 401k or a 403b, and you're on your own. The other opportunity, or the other choice, is the opportunity in PE. PE has been one of the largest drivers of returns for these pension funds. So a lot of them are going more into PE.
Yeah, because a lot of PE firms have actually returned 18 to 20%, but not every one. So how, when you allocate, do you find best in class? Because if they are paying, as we just mentioned, these higher fees, they have to get something in return.
Absolutely. And remember, all the returns that we talk about in PE are net of all of these fees. So even though that benchmarking study that you mentioned, they're finding all those extra fees that are not necessarily disclosed. But at the end of the day, the net return to PE is still in that mid to high teens.
The idea, though, of course, is that when you are investing in private equity, it's quote unquote patient capital, meaning you need to give the investment 7 to 10 years. So for any pension plan that needs to turn it around quickly, it's not really the solution.
Yes, it will be harder. If you look at some of these underfunded plans, they'll run out of money before the private equity fund they invested in will actually return their capital. That said, there's an expectation that these governments will have to come up with the money in the meantime.
So where are you seeing strength then? We pretty much have covered what you're hearing from state pension managers. As far as LPs, limited partners, people who want to invest, or institutions who want to invest more in private equity, where is the most demand coming from?
Well, demand for product or demand for money? Money is pouring in all over the place.
Right. The fundraising is almost embarrassingly easy.
Is insane. There's a large investment manager right down the road who's going to close a fund, I think $18 billion, one and done close. Incredible. But
as far as demand for the product?
As far as where you're going to put that money, that's a whole different world. If you look at some of these managers, they say that their pipeline is as long as it's ever been. But if you look at the components of that pipeline, really what's actionable is quite small. So it's going to be interesting to watch where this capital is deployed over the next year or two, because of the amounts of capital that have been raised. It's been a difficult time to deploy.
Because it's hard to find value in the U.S., right?
It is very hard. Well, it's full value, right? So you can't really plan on price multiple arbitrage. What you have to plan is some sort of growth or some sort of edge that you can take the company, whether it's global or whether it's getting rid of non-core businesses. There are things that you can do with businesses to add value.
Well, not that private equity was ever for amateurs, but more and more it's truly for the pros. Michael, it's great to see you. Thanks for coming in.
Good to see you as well.
Sharing your insight. Michael Elio joining me there from StepStone Partners, $12 billion in assets under management.